Welcome back to Finance Uncut. On today's episode, we discuss the 2 secrets the banks don't want you to know. There are 2 Wall Street secrets that the banks don't want you to know. And the first one, if you haven't yet watched my previous video, how you can print money just like Buffett, I'll put a link in the description. Go and watch that because that reveals secret number 1. A buddy of mine who worked on Wall Street, he wants me to not mention his name. He wants to remain anonymous. He also doesn't want me to share which major firms that he has worked for, but let me say he is a super successful trader on Wall Street. Shared with me recently some insights and some secrets that Wall Street don't want the public to know. In fact, what Wall Street tell you to do, they pretty much do the opposite. So understand with options that the sellers of options are called market makers, and Wall Street are the market makers. Wall Street sell a lot of options. Now, in this video, how you can print money, I talked about a particular book which actually goes into the statistics of options, where option sellers make money 96% of the time, where option buyers lose money 96% of the time. Now, what my buddy told me is the couple of key trades that they do on Wall Street, which really anybody can implement after they've done a little bit of learning and a little bit of study. The first one, and in this video that I did, you'll see that Warren Buffett sells put options. He sells a lot of put options each and every year for billions and billions of dollars in profit. And my buddy tells me that that is one of the big things that Wall Street do. They sell out of the money put options, or OTM. Now, one of the reasons why they do that is, well, they know the numbers. They see the statistics. Charles Schwab and JP Morgan did a 20-year study that showed that the market had been up 67 out of 74 times over the past 3/4 of a century. So when you go back and have a look at that, the odds are that the market goes up more times than not. And in fact, if you are a buyer of put options, your return on a weekly basis is actually negative. So you lose money. Now, I've shared in previous videos that I bought put options in March last year when the market tanked, and we made over 780% return. I very rarely buy put options, but selling out of the money put options is, well, for Buffett, it's like printing money or printing currency. The other trading secret that Wall Street do is they buy leap options. So leap options is just long-term equity anticipation securities, or in other words, just long-dated call options. So this time they're buying options, not selling. They're buying, but what they're doing is they're buying long-dated call options. So minimum 12 months usually, can be multiple year expiries. And they're looking at buying at the money or in the money call options, and their profits on these are substantial. So what they're doing is they're buying themselves time to be right. And as someone, I also trade leap options. To be honest, I look for certain circumstances, certain plays where I then buy leap options, and it might only be 3 to half a dozen times a year that I buy leap options, and I've done very, very well out of that. And one of the keys they say they get more leverage buying at the money or in the money, so they make much better returns for the risk reward than buying out of the money call options. And then lastly, the big one is selling out of the money calls. And this is what I talked about in this video, how you can print money, is covered calls. I sell out of the money calls, which means I'll get a smaller premium. but it just, and also less than 30 day. I don't, the maximum time period I sell options is maybe 60 days or 2 months. Usually it's less than 1 month, because I don't want the person buying the option time to be right on their side of the trade. So, and buying out of the money options gives me that little bit of capital gain as well, and gives me a bit of flexibility that I'm not exercising, especially when I've bought a value stock that I want to hold on to, and I'm just using covered calls to generate income or generate extra return that I can then use to reinvest. Now, my buddy also tells me this. He says, what you want to do is play with the house's money. He said it's what they call in Wall Street a grade A+ trading strategy. So what he says is invest 9% of your portfolio into call options. So these are the leaps. Set up 2 accounts, one for long-term investments and the second one for trading. Put all your money into long-term investments and then take the dividends from that, or the covered call premiums and any after-tax capital gains, and put them in your trading account. So then you're playing with the house's money. And when saving for investments, so contributions with new money, so you work in a PAYG job or whatever you do, self-employed, and you're paying yourself first or saving some of your income, put 70% of that new savings into the long-term investments account, and put 30% into the trading account. And so in the trading account, what Wall Street do, and what my buddy recommends, is you sell out of the money puts and buy leap options. And on your long-term strategy, you're just using the dividends. And if you have some stocks in that long-term portfolio that you can trade cover calls, because you can't trade cover calls on every single stock, and then you take that and put it into your trading account. So that is secret number 1. And we're about to get into secret number 2 now. The second secret that banks don't want you to know is using a master limit for debt recycling. Now, what's debt recycling? Well, before we get to this example, let's cut to a clip on Sky News.
Well, joining us tonight is John Mansamelli from Hunterwood Solutions Mortgage Brokers, and Charles Tarby, Chairman and owner of Century 21 Australasia. Well, welcome to the show, guys. Debt recycling, something new to me. What does that all mean?
It's about grabbing all the income and equity and working in a way where you can redirect all of your income into your home loan. And so if you're in a position where you've got a bit of equity in your investment property and you've got a bit of rental income, it's redirecting everything into the offset account, or everything into the home loan. So it's an old strategy that everyone seems to have forgotten about, but it's something I want to reinvigorate, because it's had a dramatic effect on a lot of my clients, and I think it might be a really good time to bring it up, given this is a good quality investment property show.
Now, Charles, whenever people think of these various different things, and I'm sure it comes and goes over the times, it's right to get the right advice, isn't it? Because you go off and do something by yourself when it comes to a mortgage, and the tax consequences, if you get it wrong, could be dramatic.
Quite dramatic, particularly when some people try to align investment loans and their own home loan, and sometimes they cross the two over and find themselves with a tax issue, a tax problem. Consolidating debt or debt recycling is a fantastic way that, as John said, has been forgotten, because if people just buy things and progressively over a period of time they've got maybe a new car or a boat or some furniture, fixtures, fittings, and they're paying a higher interest rate on that than they're going to be paying on something else, and consolidating that debt into their home loan, particularly now because there's so much more equity being gained by anybody who bought real estate 6-7 years ago in most of the country. They've got all this equity and they're not using it. They're paying 2 and 3 times the interest rate that they might be paying on something else.
So, John, what are the...
Is that what you mean? Sorry, John? Is that what you're talking
I gather
about?
there's a couple of ways to do it as well, isn't there?
Yeah, so there's 2 ways you can do it. The first way is to redirect all your rental income into your home and your PAYG income. And the idea is that you have a line of credit attached to your investment property, and you're drawing your line of credit up, and that's being used to help pay the investment property. And at the same time, your owner-occupied debt's coming down because you've got all of your rental income, PAYG income going into your home loan. So that's a cash flow technique. Now, the second part is under what's called a master limit product. We have, say, $2 million, and you have a number of home loans, and you can move the debts around so that you can remove the debt off your owner-occupied home loan and then move it onto your investment property debt. And as you correctly mentioned, you want to be careful that you don't claim that debt if you move it off your owner-occupied and put it onto your investment property debt.
And I think we've got an image that we can pull up. We've actually got it on the screen there.
On the top left-hand corner is your principal place of residence, and you can see your wages going into your home loan. And the bottom left-hand corner is your investment property with the rent. You're putting it all into your home loan. Now on the right-hand side, on the top right-hand side, you can see that you've set up a line of credit, and you draw that up and you use that money to help pay the investment home loan. So your owner-occupied debt's going down and your line of credit or some sort of credit facility is going up in value, in debt, sorry. So there's quite a tremendous opportunity there to improve the cash flow. Improve the cash flow between all the various rents and equities that you've got there. So that's called debt recycling.
So using this example, let's say you've got a property that's worth $1 million. Well, you can get a master limit of $800,000 or 80% of the value of the property. Now, let's say you've got a $500,000 home loan that you owe with XYZ Bank. Now, you refinance that home loan, but you've got a master limit of $800,000. So that gives you an extra $300,000 to use. Now, we set this up in a separate split, usually held in a line of credit, which you can see here. So you have, all of a sudden, you've got a master limit set up now. You've got your home loan or non-deductible debt or bad debt, and you have your deductible line of credit. So this is your investment debt. So we're going to use this $300,000 to invest. Now, you can invest it in whatever you and your financial planner, financial advisor come up with that suits your needs. So in year 2, what you do is you have all the either dividend income, your PAYG income, or rental income, whatever, and it goes into the non-deductible home loan. And so as that goes down, you then increase the deductible line of credit because you've still got that master limit at $800,000. So everything's going into the non-deductible home loan, but then you can draw out from the line of credit to buy more investments. Same thing again, the next year. All that extra investment income goes into the non-deductible home loan. So the non-deductible home loan is going down each and every year. And at the same time, you're increasing that deductible line of credit to use for investment purposes. And the great thing is with the master limit is that you've got that limit for $800,000. There's no need for a credit approval each year. You can change the loan structure to meet your needs at no cost. If you actually needed to create a new home loan split or a new home loan account, you can do so. You can have up to 10 different loan accounts or splits under the master limit product. But for this example, we've just got the two, the non-deductible home loan and the deductible line of credit. So that's the investment and the non-investment debt. Year 4, so now you can see that you're really starting to pay down that home loan, that non-deductible home loan, and at the same time increasing that line of credit. So you're investing more. So you're paying off your home loan while using that master limit to buy more investments and to grow your portfolio. Year 5, you can see the numbers there. So in 5 years, the non-deductible home loan or bad debt goes from $500,000 to $331,000, while the deductible line of credit or good debt goes from $300,000 to $468,000. Now, that's not taking into account your investment returns, any capital growth, or whether your portfolio goes up or down, sideways, whatever. Now, this is pretty powerful when you use an income strategy. So if you're getting dividends or if you know how to write covered calls to generate premiums on your portfolio, this can be very, very powerful and you can really pay down that home loan even faster. And in 10 years, the non-deductible home loan or bad debt is now 0, while the deductible line of credit or good debt goes to 800,000. So you've now used up that master limit, and you've got $800,000 worth of deductible investment debt, while you've paid down your non-deductible home loan debt. And hopefully in a 10-year period, your investments have grown and you've got a large investment portfolio generating really, really good investment income. And this is the secret. The second secret that the banks don't want you to know is how to use this product. Now, in Australia, there's only a couple of lenders who provide this product. If you want to know more about the master limit and debt recycling, go to our website, firstchoicefinancegroup.com.au. We're a mortgage broking business in Australia, and you can download my ebook, Ditch the Debt, 7 Steps to Paying Off Your Mortgage in 10 Years or Less. Or you can contact us by phone on 1300 123 036. That's 1300 123 036. Or send me an email at admin@firstchoicefinancegroup.com.au.
We're in a debt of a 30-year home loan. We had a couple of car loans, a boat loan. We just felt like we were getting nowhere. We just wanted to create a financial road plan that was tailored to suit us individually. We want to get rid of all the debt, pay off the house as soon as possible and start saving for retirement. The best thing is that First Choice Finance Group don't charge a fee, and they've become our personal finance coaches. Yeah, our financial future feels very secure. We're well on the road to paying the house off early. The house is the only debt we've got. We own the cars and the boat. And we're also putting a big part of our super away and planning for an early retirement.
We're on track to pay off our home loan by the time we're 55 at the latest. As we both continue to receive pay rises throughout our career, we'll continue to save, also making a nice little nest egg for us when we retire. It's the best decision that we could have made. Not only was their service free, also we felt that they had our best interest at heart, and it's the best decision that we've ever made. We're happier knowing that we're on the right track to retire at a nice early age and also have a nice little fund sitting there. Anyone who wants to work towards a debt-free life and early retirement, we definitely recommend giving First Choice Finance a call.